Welcome back. In this session, I will focus on introducing accrual basis. According to IAS 1, it said an entity shall prepare its financial statement except for cash flow information using accrual basis of accounting. It means that under this method, transactions and events are recognized when they occur, not as cash, where its equivalent is received or paid. Also means that recognized in the accounting records and reported in the financial statement of the period to which they relate. Accrual accounting creates a timing difference between the recognition of revenue and expenses and their cash implication. In the later stage of the discourses, you will learn how to prepare for cash flow statement, and then you will be able to see how this timing difference is having an impact. Let's just have a quick example. Company A has a sales contract to sell 50 units of product A to Company B. At the end of August, when it prepares its financial statement, Company A found it's only delivered 40 units to the Company B. It has received a payment from the Company B for all 50 units in advance. So how much revenue would Company A recognize in its August financial statement? Again, I would like you to pause the video and to think, how would you answer this question? The answer to this would be Company A can only recognize and measure revenue for 40 units that are sold and delivered to Company B. Although Company A has received the entire payment for the 50 units, it had only delivered to Company B for 40 units. It has not effectively earned the revenue for all 50 units. Here's another example. In January, you have made 5 sales, and that gives you a sales revenue of 15,000. But however, you do not receive payment for all of them, so you only receive 7,000 in cash that has been paid during January. So have a think about how much would you recognize as your revenue has been obtained in January. Would you recognize the 15,000 or would you recognize the 7,000? So have a pause the video and think a bit before you move to the next slides. And in this case, you have to use accrual basis. So the revenue that you have earned is 15,000, not the 7,000. And the difference between 15,000 and 7,000 is 8,000. And that is something that you're going to put into your account receivable as part of your current assets. Another example, the sales that you have invoiced in year is 195,000, and the cash that you have received from the customer is 172,500. So clearly there is a difference between here. The purchase that you have invoiced is 166,000 and you have paid your suppliers for 129. So which indicates that you have a payable, you need to pay more. The expenses that you have invoiced is 22,500 and the cash you have actually paid is 21,600. The rent that you have paid is 6,250. Let's have a look at how those things are addressed. First of all, you see what is the actual cash that you have received from the customer, and that is 172,500. The actual cash out, which is something that you have actually made the payment, and those be the actual payment you have made to your suppliers, the actual expenses that you have made, and also the rent that you have paid, although it's paid for 2 years. So the net cash flow is 15,650, and that is your cash inflow. If we follow what is presented in the previous slides of how to calculate the inflow and outflow of the cash, and we take that as a basis for recognizing our revenue, then we would recognize the around 15,000 revenue. There are certain benefits of doing that because it's very simple and straightforward. It simply just tells you how much cash that you have left at your hand. So it reflects the economic reality that the business needs the cash to survive, so the cash in the bank. But there are a lot of disadvantages because it only includes past and cash-based items. So for example, you have made a purchase, so there are some other things liability, the further liability that you need to pay for your suppliers is not recognized. You have made some prepayment of the rent for 2 years, but it's not being recognized as a current asset. So that means you will be paying very much this year, but next year you're paying zero. So in your profit and loss account, you will see a huge difference because of that. So ignores the fact that we should get cash receipt and make payment in the future for items that has occurred in the current period. So it shows the cash balance, but it's not a profit and loss account. So the right way of doing to recognize and to present the revenue and purchase and expenses would be like this. You would account for the revenue that is 190,000, 95,000. The purchase that you have made, you have invoiced, not the purchase that you have made the payment. The expense that you have invoiced and the rent that is only for this year, not for 2 years. And that will give you a profit of 3,375. So that's a huge difference between your cash basis calculation. And that shows how much profit you actually generated after clear your balance, after clear your liability to pay your suppliers, and also clear your liability to pay more expenses. It only gives you 3,375 as a profit, which is very different from you think that you have 15,000, but that is not your profit because you still have to leave a big proportion of that for payment to your suppliers and expenses. We could also start from the profit and work all the way back to calculate the cash flow that we have worked out in a cash base. And by reducing the amount that we're supposed to receive, because we recognize them as a revenue, but those are the payments we haven't received from our customers. We have not made some payment, and those payments would be considered as the cash that we're still holding in hand, that are 37,900. So by working backwards, we would be able to work out that we do have 15,650 in hand, and that's the cash in bank. Don't worry if this seems to be a bit too quick for you. We will be able to cover the cash flow statement in the later section. So what kind of a transaction does accrual accounting record? It does record cash transaction, like collecting cash from customers, receiving cash from interest earned, paying salaries, rent, or other expenses. You borrow money from the bank, you're paying off your loans, you're issuing shares, and you get the money. It also records non-cash transactions such as sales on credit, you purchase inventory on credit, the accrual expenses incurred but not yet paid, the depreciation and amortization expenses. So it's something that you're not actually paying out the depreciation, but it's the decrease in your asset value. The earnings of revenue with cash was collected in advance. So accrual accounting actually helps to adjust the realized operating cash flows for transactions still not converted into cash at the end of the period. It includes in the period income any invoices issued but where cash has still not been received. Includes in the period of expenses any invoice received, but where cash has still to be paid out. So very easy to understand is you have made the order, you have received the stock, and it is recognized on your financial statement as your asset, but you have now actually made the payment. So that becomes your part of your liability, so it's become a trade payable. Or if you have sell some products, some stocks, and that has been realized, but you have not received the cash from your customers, and that would be recognized as a receivable, but your asset has been decreased. So that's kind of you need kind of a credit. You need to credit your asset, and then you debit your receivable. So the IASB regards the accrual basis as more useful than the cash accounting in making economic decisions.